Dividend growth is a great strategy. Companies that pay growing dividends outperform companies that don't pay dividends or don't grow them. It'll build you a passive income stream for sure. Most people think that the growth rate of the dividend is the most important part in this strategy, but it's not. You definitely need the growth, but this strategy works even better if you buy a dividend grower at a high starting yield. Usually that means you're buying it at a lower price. Something's going on with the company, maybe it's just a market crash, but if you can get these great companies that will pay you more and more cash at a lower starting price, you'll do even better. And I'll prove it, do the math. So let's figure out how long it would take for your investment to pay you back in dividends based on a few different starting yields and the growth rate. So the S&P is a 1.3% yield, the growth rate's about 5.3%, and that takes you 31 years to get your original investment back. Now, the S&P is not great for dividend growth, so let's use the growth rate of something better, like SCHD. That's 10.7% per year. So if you start at 1.3% and it grows at 10.7, it takes 21 years. SCHD yields about 3.9%, and if you start there, it gets you down to 13 years. So that's the key. You need the strong growth, but the high starting yield is what turns a good investment into a great one. And so today we're going to look at 5 stocks that all have better growth rates and starting yields than the S&P 500. If you're new here, I'm TJ. I write Compounding Dividends. It's a newsletter with 150,000 plus subscribers. And the goal is to build a durable, growing income stream that you can count on no matter what the market does. We own great businesses, we collect our share of the profits, and we grow our wealth. So if you're interested, compoundingdividends.net, you can go check it out. But let's get into it.
Let's start with Mondelez. They make their money by selling snacks and confectionery. So think about Oreo cookies, Cadbury chocolate, Triscuit crackers, Ritz, Toblerone, Halls, all kind of things. This is a diversified consumer packaged goods company. And you can see here that their dividend yield is above where it typically is, up 2.8, around 3. Typically this thing's floating between 2, 2.5. So it looks a little undervalued on this measure. So as I said, yield's about 2.8%. The payout ratio is fairly reasonable, around 68%. The 10-year dividend CAGR, so that's compound annual growth rate, it's about 12% per year. That's a nice growth rate. The net profit margin there is almost 10%. The forward PE is 21.1. Let's move on to SBA Communications. They own and lease wireless communication towers and infrastructure. So basically they collect rent from mobile carriers, broadband providers, private networks for them to stick their equipment up on the towers. Here's their dividend yield. You can see it's been climbing since 2022. We're up close to 2%. The payout ratio, nice and low, 53.4%. 10-year dividend CAGR, 19.4%. That's impressive, especially starting near a 2% yield. Profit margin, nice and high, 30.4%. Forward PE, 26.1. When you consider that almost 20% dividend CAGR, that's a nice forward PE as well. SS&C Technology, they do software and tech services for financial institutions like asset managers, insurance companies, banks. They also include portfolio analytics, accounting platforms, and some enterprise technologies. So this is a software and service company. Here's their dividend yield, up over 1%, 1.24. You can see that's significantly higher than where it's been between 2016 and 2022. There's that yield again. Payout ratio, very low, 29.9. 10-year CAGR, 23%, another really impressive dividend grower. The profit margin, 13.7. That's not bad, maybe a little bit low for a tech company. Forward PE, nice and low, 13.4. Elevance Health, this is formerly Anthem. They sell health insurance plans across the U.S. That covers individuals, employers, government programs like Medicare, Medicaid. They also have some health providers. So here's their dividend yield. You can see it's jumped up the kind of end of 2024 and this year, up 1.75%. So the payout ratio, again, nice and low, plenty of room to grow it at 25.7%. Their CAGR, 13%. Not quite as high as some of the other ones, but still respectable. Profit margin 3.2. That's not unusual in the health and insurance space. And their forward PE only 11.1. Last but not least, we have UnitedHealth. They have two segments. That's UnitedHealthcare, that's their insurance arm, and then Care Services is Optum. So health premiums make up the majority of their revenue, and here is their dividend yield. So if you're not aware, they have been in the news recently with the CEO stepping down, some accusations of potential fraud. They've pulled their guidance. There's a lot of things that are going wrong at the moment, but if you believe long term that the company is going to survive, this could be a nice opportunity. So there's that dividend yield. Payout ratio, again, nice and low, 34.9%. So lots of profit left over to reinvest in the business and grow. The CAGR for the last 10 years is almost 19%. That's pretty impressive. The profit margin higher than Elevance at 5.4. And then our forward PE only 13.2.
So there you go. 5 companies with good starting yields and good growth rates. If you're interested, go ahead and do some more research on them. There's a breakdown on all 5 at the Compounding Dividends website. And if you like this video, don't forget to subscribe. We'll be producing more for dividend growth investors just like you.